Hello everyone. So I hope everyone's doing okay. I just wanted to give you guys a quick update on the performance of this running trade that I've set to run for. It's been going for about 27 days now, and we've got another month or so of projected runtime for this. That's how I've designed this strategy. So let's have a look at what we've got so far. So immediately looking at the overall P&L analysis, we can see that we're down right now, and that's fine. I'll explain in a minute why we're down. But first of all, I didn't want you guys to think that I'm only giving you updates when things are positive. I'm also transparent when things aren't as positive because I'm not trying to fake my stats. So even on the exchange, if I go right now, this is my current balance, whereas I started with 1,822 about 3 to 4 weeks ago. So we're actually down about $200. So that's like something like 15-16% down. Just some quick maths. And that's kind of fine because I expect things to take a turn for the positive soon. And why I say that is because I'm about to give you guys the secret sauce. So if I go to TradingView, this is a plot of the volatility, the current volatility of Ethereum prices as computed by Deribit, which is like the main options provider for ETH, which options is something we use heavily for this strategy. So what I'm plotting here in red is areas where the volatility is under 64. I've chosen that 64 level to be like a key level because you can see wherever this is over the past year. I think this is since December 24. So whenever volatility falls under that 64 level, wherever you see these red bars, it soon after begins to shoot up. And we make money with this strategy by buying in when volatility is low and then waiting for volatility to spike, to shoot up. And right now, we're in a red zone, we're in a red volatility environment. So things are kind of quiet, and that's expected. It's well known that September is a month when nothing really happens in crypto. So that was kind of expected. And bear in mind that we bought these options as volatility was starting to fall down. So we bought a bit of options here, some here, some here. Some, we kind of DC'd into these options. I bought some here, I bought some here, bought some here. And right now volatility is still low. So these options are kind of losing value right now because they also appreciate with volatility. So what we're waiting to happen is really this spike up. We're waiting to get out of this red zone, this entry signal zone where you want to start buying, but now we want volatility to start shooting up so that our options become more valuable and so that also our grid bot starts printing money. And so until that happens, we're expecting this to not do much or even kind of lose money. But really that's expected just by looking at this plot. So I guess the other thing is obviously we have a bit more call options than put options, I think. I'll have to double check that. Yeah, I'm a bit lazy to go and look through all of these, but yeah, we're a bit more call heavy, so I've set this up in a way that we're more hedged to the upside than to the downside, but we're kind of equally hedged to both sides. So just looking at this, if price was to completely crash all the way down to 3,000, which is kind of around where this red line here, this thin red line, is where I've set the bot to end. This is where the capital invested in our grid bot would get liquidated anyway by the exchange. But if we reach all the way here, we've already made like $500 plus of profit. That's more than 30%. Is it? No, sorry, it's not. It's like between 25 and 30% profit. So if price were to completely crash, I'm happy with that. Equally, if price was to completely shoot up around the 6,000 levels where we'd get liquidated to the upside, if price was to completely shoot up, again, we'd be making about 500. This line is actually going to get even steeper as we move upwards in price. That's the characteristic of this model. It's that it um, underestimates how steep this line is until you actually get close to the price. So because you're far off from this price, this line is actually gonna be a lot steeper if we actually reach there. So around $500 as well. So to to both ends of this grid, and when I say ends, I don't mean here where we're actually making money with the grid, but if we completely leave the range catastrophically by like $1,000, if if stuff hits the fan to either side, we've got our 25 to 30% profit immediately, and we're good. We're out, and this is what tends to happen. Um, but equally, if price just like starts moving again in this range, volatility starts increasing. Even if we don't leave the range by a lot, we're still going to be pretty happy. Because first of all, the options are going to appreciate in value, the options themselves, and then also the grid bot is going to start printing money. So we're still going to end up with something pretty good in that situation. All we need right now, really, is for this volatility to start shooting up. I don't even care about direction, just it needs to become more volatile. And if you look at this plot, that's usually what tends to happen. Like, this is actually the longest period of low volatility where we've been in this like super low volatility range over the past year. So we're more likely to see increased volatility than we are to not see it. And that's what a good trade is. We're more likely to see profits than to lose. And yeah, I mean, I guess we're just gonna wait this out. Is there anything else I wanted to show? Well, not really. That's pretty much about it, I think. And yeah, we'll just wait for this to start moving like crazy as it usually does. I mean, the last thing to say would be that obviously there's no strategy that wins 100% of the time. The case where we'd lose with this is if price kind of moved into this dip here and stayed here and didn't continue to crash even further, because in that case, we're not making any money on the grid bot. We're not in the grid anymore. We're also not far out enough to where we've got the put options appreciating massively. So this would be like this little earlobe, this little hole here is if price were to just drop in there and stay there, that would be a problem. Equally to the upside, we've also got an earlobe here where if price were to just hit 5,200 and then not move anymore, not drop, not rise, just stay there, equally that would be a problem. But this is exactly the risk that I've decided to take with this strategy. I've decided to create a payoff structure where we have these little earlobes, these intermediary earlobes, kind of right outside of the grid. We have these earlobes, and then if we cross the lobes, we're in profit again, both to the upside or the downside. Because my whole assertion here is usually when price moves down out of the range, it won't just stay down by a little bit. It will just crash. Will keep crashing. And equally to the upside, when price sort of breaks out, it won't just stay there. It will just keep breaking out. So this is the main assumption that I'm making with the strategy, is that no single $300 range is going to keep the price within it for that long. Like, even if price were to end up in there for a few days or a week, it wouldn't stay there for very long. It will either come back into the grid or keep crashing. And that's kind of the whole argument for using this strategy. So I hope that's all clear. I hope I've given you guys some more clarity as to why I'm doing this the way that I'm doing it. And yeah, I hope you guys stay tuned for when this actually comes into the money. I'm excited to share future profits with you guys. And yeah, I'll see you guys in the next one.